Welcome back to Smart Money Monday. We all borrow money for things like mortgages, student loans, and credit cards. But what happens if we borrow a little too much? That doesn't sound very good. To help us answer that question, we have Keane Santos from Bank of Hawaii. Hey, Keane.
Hey, Steve.
How are you?
Again.
Okay, so is there a technical way to determine that we borrow too much?
Yeah, so in banking, we actually have a formula. It's called a debt-to-income ratio.
Okay, so how does that debt-to-income ratio work?
It's pretty simple. So you take your monthly debt, let's say it's about $1,000. Then you take your monthly income, let's say that's $2,000. Your debt and related to your income, in that case, would be 50%. That would be your debt-to-income ratio.
So is that the percentage that we're looking for?
There's no hard rule, but the lower the better, because that's going to give you more flexibility for your day-to-day spending. But if you can remember that 50% and just try to stay under it, that's a good rule of thumb to start with.
Under would be good. So how do we get it under? What do we do?
First thing to look at is if there's any loans you can pay off. So for example, let's say you have a car loan for 5 years and you're in the last year of that loan. You might have some money sitting aside that you can pay that off and ultimately get rid of that monthly payment altogether. That'd be a good example.
So a lot of us have a lot of debt. How do we decide which one we need to pay off first?
Right, so if you pay the highest interest rate, that's always going to save you the most money. But the other thing you can look at is for your variable debts, like credit cards, lines of credits, or home equity loans, paying those balances will actually reduce your monthly payment. That can also help with your debt-to-income ratio.
So we're getting kind of the hang of this whole ratio thing. What else do we need to know?
So there's balance transfers. If you have credit cards, there's 0% balance transfer offers. You can move your debt to a 0% card and ultimately give yourself a break on the interest you're paying. What you do want to be aware of is possible balance transfer fees to make sure that's worthwhile.
What about refinancing your debt?
Great. Refinancing, one of the best things you can do. So if you sit with someone and you qualify, you can potentially take a bunch of your debts and you get to do one of two things. First thing is get a lower rate, pay less interest. But the second thing might be as simple as just taking a bunch of those little payments, bundling them together and paying a lower monthly overall.
All right, so lots to think about. Keane Santos, Bank of Hawaii, thank you.
See you again, Steve.
Thank you. And thank you for watching Smart Money Monday.